Perfect. So thanks everyone for joining. I really appreciate it. Today is the first time homebuyer masterclass. What we're going to go over is essentially everything that pertains to buying a property. If you're brand new to just starting out, we'll have all of your questions answered. And if you have questions throughout the webinar, feel free to drop it in the chat. Or unmute yourself and ask. There are breaks during the class to answer any questions. So when we look at being a first-time home buyer, or in the situation where you're at, where you're looking at buying a property, are you concerned, not sure where to go, where to start, what the first steps are? Does it stress you out, making you think that, oh my gosh, I don't know what to do. I don't know what's next. Are you just intimidated by the paperwork and next steps? Are you anxious, thinking, oh my gosh, I'll never qualify. This is so hard. It's so confusing. And are you uncertain of the terms? If you are, don't worry. This class will cover most all of the questions. And I am available afterwards to answer any questions that you have. And there will be opportunities where we can sit down and have a one-on-one meeting so I can answer any questions that you have. So let's start with the terminology. What is a first-time home buyer? A first-time home buyer is referred to as any of the following criteria. Either you have no prior ownership of a house at all, you've never owned one, or you have not owned one in 3 years. Let's say you bought one, you moved out, and you no longer own that house. Well, then you're considered a first-time home buyer. And why is that important? That is important when it comes to some grants, some down payment assistance requires you to be a first-time home buyer. So primary residence is considered a residence that you're going to live in as your primary property. So for a VA loan, you would be buying a primary residence. And let's start with the next one. Hold on. So what are the key steps to home ownership? So where do you even go about starting? You would go about starting with getting a pre-approval. And when you get a pre-approval, to schedule an appointment with me at any time. This link here, it's an appointment with Karen link. That will set a one-on-one appointment where I can answer any questions you have or go over numbers or figures or anything that you have specific for your particular situation. So you would get a pre-qualification or a pre-approval. In the class, I'll explain what the difference of those are and why they're important. Also what a fast track approval is and how that helps you win out in multiple offer situations. Next, you'll find a realtor in your area. So a lot of you are working with or know a local realtor. And what you'll do is have a buyer consultation with that realtor. Then you will sign a buyer agency agreement. We're going to cover what a buyer agency agreement is. The laws changed the 17th of last month. So now things are done a little bit different with a lot more transparency for the buyers and the sellers in the on the real estate side. And sorry, I'm letting people in as I'm talking. So then you'll go out hunting with your realtor. So after you find the buyer agency agreement, after you get approved, then you'll start looking at properties with your realtor. You'll offer and negotiate so you'll make an offer, you'll negotiate the terms, and then you execute the contract. And then you'll go through an attorney review period, depending on what state you're buying in. Not all states require attorneys. And then you'll go through the home inspection or condo review if you're buying a condo. And then we will issue a loan commitment. You'll do your final walkthrough. You sign at the title company. And then you get the keys, you move in, and then you have your housewarming party. It's an easy process to go through the paperwork and the home buying process. It just takes a little bit of time and a little bit of organization. So mistake number one, if we look at what are the common mistakes when it comes to buying, the biggest mistake, bar none to start with, is continuing to rent versus buying. This can cost you up to $248,000. And the way that it can cost you that much money is home ownership enables you to build wealth. According to a federal survey in 2019, the median net worth of homeowner was about 255,000, whereas the net worth of a renter was $6,300. So a homeowner has 40 times more wealth than a renter does. And that is super impactful because a lot of that comes from the equity that you're going to accrue when it comes to buying the property. And also, it will come with appreciation over time. And it hedges against inflation because rising housing costs, as people are finding out now with rentals, the rents keep going up astronomically. Landlords are, oh, your rent's up or your lease is up, now it's time to increase it. When you own your own home, it stops that from happening because the rate that you're starting with is fixed. So your housing payment is going to stay consistent and predictable for you. So if we look at the gap of wealth when it comes to people who own versus not, if you look back to 2010, the net worth of a renter was about $6,000, but the homeowner was at $203,000. From doing nothing different than owning a house and time, fast forward to 2019, the renter was about $6,300 in wealth and the homeowner was $254,000. Huge difference from just owning a house. When we look at the path to wealth building and how this is so important, it's asset diversification because your real estate is only one portion of the wealth that you're going to be accruing. Because as a homeowner, you actually are reducing the principal on the property every month when you make a payment. Therefore, you're gaining equity in the property monthly. It hedges against inflation. So when we look at inflation, the price of everything goes up, but your house will stay static as far as the payment goes. And with that stable housing cost, it is enabling you to have predictable payments. Also, it enables you to create generational wealth. You have something tangible that you're able to pass down to your family. You're able to have your kids have the house, and you're also able to teach your children and family members how to create generational wealth themselves. It's a forced savings mechanism. So if you think about renting, if you add up how much that you've paid in rent over all the years, and all that money just went to go pay that landlord's debt down. When it comes to a house, you can sell it, you can refinance it, you can use that equity that you're accruing over time in a tax-free format to be able to do what you want to do in life. So next, we're going to talk about not knowing all the financing options. A lot of people will come to me and they're not sure which loan is the right loan. They're not even sure what loans are out there. So let's talk a little about where do loans come from and the different loan products and how much money you actually need down in order to buy. So let's start with where do loans come from? So when you work with a loan officer, they're your lender. And we have a line of credit as mortgage bankers or as a broker. Someone's using a line of credit. That line of credit has to be refurbished or replenished. So as we lend money out, we have to get that money back in from somewhere. So there are large companies that back those loans to get the money back into the market. So you may have heard of Freddie Mac, Fannie Mae, HUD, VA, USDA. Those are all different companies that back these loans. And that's truly where the loans actually originate from. So not all lenders are created equal. Mortgage bankers provide the access to most programs. So if you were to go to, let's say, Chase Bank, the difference between Chase Bank and the products that a lender like me would have is Chase has what's in their little bucket. And somebody like me has their bucket plus other lenders' buckets. And we're able to pick which lender we want to use and which one has the most favorable terms for you, the consumer. Large banks don't offer all the loan programs. So there are some products that, again, I'll just pick on Chase just because I bank there. So they may not have FHA, they may not have VA, USDA, down payment assistance, and non-qualified mortgages. So I'll go over what a non-qualified mortgage is. So banks and credit unions, their core business is to grow their deposits, and they mark up lending at a premium. They have brick and mortar expenses, and they have a bank on every corner. So they typically have stricter guidelines, and they want to stay within their lending box. And at a bank, you're just a number to them and how much money you deposit into their company. So let's talk about the types of loans. So you have a conventional loan, you have a conventional renovation loan, FHA, FHA renovation, VA, USDA, and then non-qualified mortgages. So non-qualified mortgage and DSCR loans are for out-of-the-box kind of buyers. So if somebody is self-employed, they need a bank statement loan. They're an investor. There are different key loans for somebody that's out of the box. So if you're in that category, then we need to talk because there's different rules than what I'm going to cover. It's kind of nichey. So let's talk about a down payment and how much do you actually need to buy a house. So with a conventional loan, the misconception is you need 20% down. You don't. There is a 3% down conventional community lending product. There's 5% down conventional. And there's 3 to 5% down conventional renovation. What is a renovation loan? If you're out looking at properties or if you've seen any properties online and it has a pink tub, blue toilet, shag carpet, and you know it smells in there, and you think, oh my God, it's the right block, but I am not moving in that house. I wouldn't even put my dog in that house. Well, there's a renovation loan. And with the renovation loan, we give you the money to buy it, plus fix it up. You pick the contractor and you pick the finishes. So that's available from FHA and conventional. So if it's move-in ready, you could do as little as 3.5% down FHA and 3.5% down FHA renovation. So you can do an owner-occupied renovation on 1 to 4 unit for conventional and FHA. You'll hear some people call the FHA renovation a 203K. So VA loans. So if you have a 1 to 4 unit, you could buy a VA loan with 0 down. You can get a seller credit of 4%, and then in most cases come to closing with no money. You can get seller credits for conventional and FHA loans also. So USDA, if anybody is buying far west, far south, there is a USDA loan. It is 0% down, similar to VA. And then non-qualified mortgage. So let's say you're paid with a 1099 or you own your own business and you have a lot of cash deposits. It's 10% down. And then if you're an investor who is buying with a loan that's called a debt coverage ratio loan, which means that we're not looking at your income as the investor, we're looking at how much money the property cash flows, then it's 20% down. So you can see there's a big variety of down payments plus loan programs that are available. So let's look at mortgage insurance versus property insurance. This is a confusing thing when it comes up. So mortgage insurance protects the lender in the event of default from the buyer. So let's say life happens and you can't make the payment and the bank needs to take that property back. The mortgage insurance will cover that. Where homeowners insurance is, let's say your neighbor's tree, a limb breaks off, falls on your roof, ruins your roof, and your house is flooded. Property insurance will cover that. So if you put less than 20% down with a conventional loan, you'll have mortgage insurance. If you buy with an FHA loan, you will have mortgage insurance. So mortgage insurance, people will always ask me what's better, FHA or conventional, because of mortgage insurance. If you make your normal everyday monthly payments, it will take you approximately 10 years to accrue 20% versus of equity. With an FHA loan, you will pay mortgage insurance if you put less than 10% down for the life of the loan. So the typical buyer, if you move every 8 years, then paying the mortgage insurance isn't that big of a deal to some people, but some people it is. So we would just have to have that discussion of how long do you plan on living there to see which loan is the best for you if you were to never refinance or sell. So let's look at how much cash do you actually need to bring to closing, because saving up money is the most stressful part for a lot of people. So let's say you want to buy a home, it's $300,000. The down payment with an FHA loan is $10,500. So that's the minimum investment of $10,500 is what we need to see in your bank account. Now, the closing costs are estimated about $9,000. You have things like title insurance, you'll have lender fees, you have escrows that need to get set up. So once all the fees are there, you're looking at about $9,000. Now, if we add all of that up, it's $19,500. If the seller gives you a credit of, let's say, $9,000, and you get a gift for $5,000, your cash to close in this scenario is only $5,500. If we were adding seller credit and down payment assistance in, with down payment assistance, there is a program where you can get 5% of the purchase price. You can get up to $10,000. So there's a lot of different choices that will help to reduce what you need to bring to closing. We just need to see what works for you.
You went back, right?
So with an FHA loan. So what an FHA loan is it's a type of mortgage that's insured by the Federal Housing Administration. It is specifically designed to help first-time buyers qualify for a mortgage that has more flexible lending requirements. So it allows you to have a higher debt to income ratio. It has lower interest rates than conventional typically. The mortgage insurance is a little bit higher, and it also allows you to put 3.5% down. So an FHA loan is a great loan. So a conventional loan, that loan is backed by Fannie Mae or Freddie Mac, where FHA loans are backed by the government. So with Fannie Mae or Freddie Mac, they set their lending guidelines and their rules. So the benefits of an FHA loan, you can do this with a credit score as low as 580. If you have a credit score at 500, some lenders do allow you a 10% down to lend. Our company is not one of them. So I would have to help you find somebody that is if you're in that situation. It's easy to refinance an FHA loan with an FHA Streamline. So right now, we're in a situation where we know rates are a little bit higher. We're hoping that they're going to come down, right? So when we qualify somebody, I tell them, look at the monthly payment, not necessarily the rate. Because as rates fluctuate, at some point, you will be able to refinance it. Look at what can you qualify for today and what are you comfortable paying for? And that's what we look at today's scenario. With an FHA Streamline, it's barely any paperwork in order to refinance when rates go down. So, like I said, they have lower mortgage rates. They have higher debt ratios. So you could go up to a 56%, 56.9% debt ratio, which to calculate your debt ratio, what we look at is we take all of your minimum monthly payments plus the price of the house, and we divide all that monthly debt by what your gross monthly income is. And that's how we calculate your debt to income ratio. So you can choose between a 15-year or a 30-year fixed rate or adjustable rate. And we'll go over the adjustable and fixed rates in a loan consultation and which one's better at that time for you. Down payment assistance and grants are accepted in both programs. The seller can pay closing costs up to 6%, which is a big help these days. So down payment assistance, let's talk about the pros and cons of down payment assistance. So you don't have to be a first-time home buyer in Illinois to get the down payment assistance program. That changed a couple of years back. Any buyer can get it as long as it's their primary residence. Down payment assistance typically have higher interest rates. No money is free. So the rate is a little bit higher because they are extending this extra money to you. So it may have higher points. The one in Illinois does not. Indiana also does not have higher points, but there are some programs that are national that do have higher points. So they do have credit score requirements. Down payment assistance in Illinois and Indiana are 640. And they do have income requirements. The cutoff for income in Illinois is, I believe, 175,000. And they have the debt to income ratio limit is lower. It's 45%, and the income is 175. And it may have to be paid back in full, monthly payments, or forgiven over a longer period of time. It just will depend on which program that you pick. And they do have housing price limits. So we would have to determine if you're buying in Illinois or Indiana to see what the housing price limits are. Negative equity. When you buy with down payment assistance, whether it is forgiven, paid back over time, you start in a negative equity position. What that means is when you buy a house, let's say it's $300,000, the appraiser comes out to the house and says, yes, it's worth $300,000. If you have down payment assistance of, let's say, $20,000, $12,000, then you owe the 300 plus the 12. So when you're looking at refinancing in the future, keep in mind, did you have down payment assistance? Or when you go to sell, and know the term of when you have to pay that back. So when we go through the loan consultation, I will go over that step by step with you. So that way you're not taken by surprise of, oh, I have a second loan. Now, a grant is different than down payment assistance. A grant is usually financial assistance by the government for home buyers, and it's local to the area where you're at. So some towns offer it, some counties offer it. In Cook County, in Illinois, there is a new grant that just came out. It does have limited funds. You can get up to 5% of the purchase price, and it's forgiven over time. And you can, apply for that. There are some cities that actually have grants also. It can cover your down payment, closing cost, and in some cases, home repair, depending on the grant that you pick. So they do have eligibility requirements. It's location, income, some are jobs, some are credit scores. It just depends on that particular grant. They typically do not need to get paid back, but they are forgiven over time. And they typically have a required time period that you have to physically live in that house. Now, let's look at the difference of FHA versus conventional and minimum down payments, and let's compare them apples to apples next to each other. So if you have a minimum down payment of an FHA loan at 3.5%, conventional is 3% to 5%. Minimum credit score for conventional or FHA in most cases is 580. Conventional is 620. Debt ratio 56.9 for FHA, 50 for conventional. Loan limits. Now the loan limits I forgot to update the slide. They increased this week for conventional. So for a single family home for FHA, 498, 257. If you go with a 2-unit, you're at 637, 3-unit, 771, 4-unit, 958. For conventional, you're at 766, 981, 1.1, 1.4. Minimum required investment. What this means is before you deduct any seller credits, any tax credit, anything that you're going to get, I need to show that you have 3.5% of the down payment or 3.5% of the purchase price somewhere in the bank to show that you have the money to put down on the minimum. Now, it doesn't mean you have to bring that to closing. So retirement funds, gifts, stocks, bonds, those are all used for that minimum investment requirement. For conventional, it's 3.5% to 5%. So let's talk about what you can use to pay for or have for the minimum required investment. So 401k, yes, you can use that. You can sell property. You can sell a car. No, I didn't. It's not a typo. Yes, I've had people sell goats, motorcycles, jewelry. You can. We need a receipt showing that you've sold that. If it's a car, motorcycle, something that has a title, I need a copy of the signed title too. You can get a gift from immediate family. Immediate family is mother, brother, sister, aunt, or uncle. Fiance, it doesn't count. Fiance's mother doesn't count. It has to be direct immediate family. Savings in the bank, stocks, bonds, certificates, yes. Credit cards, no. We cannot use a cash advance from a credit card as a down payment. A loan, you can use a loan as long as it's secured by collateral. So what does that mean? Let's say you have a car, you paid off the car, but you need $5,000 for closing. You can go get a loan on your car and use that for the down payment. And then cash in your drawer, no. So if you have cash in the house, put it in the bank because it needs to sit in the bank and we have to show that it's seasoned in the bank in order to use those funds towards your home purchase. Now, if you have a boyfriend whose account that they're not on the loan, but they're living with you, you cannot use their bank account and you can't use the funds. So recently I had a situation where a borrower took the earnest money that she was using, transferred it to her boyfriend's account, and then wrote the earnest money check from there. It creates a big paperwork nightmare in that case. So don't put money in somebody else's bank account without talking to me first, because it may create more of a headache for you. So first-time home buyers, I work with a lot of them. I spend a lot of time going over the process of buying and explaining to everybody the ins and outs of buying. So if you have questions along the way, myself and my team are here to guide you through that process. So my team member, my loan partner, her name is Rachel, and this is what she looks like. So most of you get to see me on the webinars. And with Rachel and I, we are mortgage bankers. So we have the ability to lend. When we talked about the buckets and where we can get money from, we can lend from our particular products plus other banks' buckets per se. And then we will work to find the right product for you for your particular situation. Now, it's not just the two of us that are working on your loan. There's a full team of people within the disclosures, processing, underwriting, lock department, quality control, closing, funding, post-closing. So it takes a village to get the loans through, where it seems like it's pretty seamless and there might not be stuff necessarily going on. It's one of the other departments are working on the loans. Personally, I started in the business back in 2001. I started on the real estate side and then moved into banking about 2013. 2008, I managed large portfolios of homes for banks. So, does anyone have any questions at this point? If so,
I have a question.
sure.
Hi, hello.
Hi.
I want to know, can we get a can we have a home mortgage if we have student loans?
So that's a great question, Victoria. So you can actually have 10 loans at any given time. So
Oh.
let's say you bought a house, you've moved out, and that house is being rented, and you want to go buy a new one. Yes, you can do that. So what some people do is they will buy a property and then every 2 years they move, because that enables them to not pay capital gains, and they're able to just go buy a new property and keep adding to their rental portfolio that way.
Does that apply to student loans?
So for student loans,
Yes.
so student loans are counted into your debt, and the way that they're counted into your debt ratio is dependent on the loan program that we use. So if you're on an income-based repayment plan for your student loans of, let's say, $5, if you have $300,000 in debt for student loans, but you're only paying $5 a month, that's all I'm using for your debt ratio.
It's $5?
$5, yep.
Oh,
So
wow. Okay.
if people have a lot of student loans, I will ask them, please call and get on an income-based repayment plan, because that's going to change your whole buying parameter. FHA has their own rule of what they allow for a calculation if they're in deferment. Conventional has theirs, and VA has theirs too. So we just have to look at what your particular situation is.
So
Okay.
it can be deferred.
Say that one person would say that again.
I'm so sorry.
That's
so
okay.
sorry. I was gonna say, because mine was deferred, so I don't know how would that go.
Okay,
I'm
so
no longer paying my monthly
right.
payment.
So what we'll do is we'll look at your outstanding balance that you have, if they're deferred, and then we'll calculate that into the debt ratio. If need be, we can go and get them put back onto an income-based repayment plan, or just use the calculation if it was deferred and your debt ratio supported being able to do that. And
okay,
the link here for the Bitly appointment with Karen, when you schedule that, it is a one-on-one meeting with me and my team. And I can't unfortunately put it in the chat. So hopefully you guys can write that down. I was supposed to copy it and put it in the chat, but I didn't do that beforehand. Sorry.
Can you email that information?
So yes, everyone will get an appointment link afterwards. I'll text it to everybody to schedule an appointment. That way then I'll send it off to everybody.
Yeah,
okay.
Because I have questions.
Sure.
I have no student loan debt. They were all forgiven by VA.
Okay.
And I was trying to use my VA to get a home.
Okay.
And I just don't know what to do, how to go about doing it, or anything like that.
Sure. Yep. So I will reach out to you, and we will get you through that process. So with a VA, if anybody else is in the same situation, with a VA loan, we have to get what's called a certificate of eligibility, which
Already have it.
Oh, you do? Okay, perfect. You're a step ahead, because I was gonna say Rachel and I can order that. So with that, what we'll do is we'll call you and walk you through the process of taking the application and then getting you approved from there. And
okay, so much.
Let's go on to the next one of not getting pre-approved. So a lot of people will not want to get approved at the point of, when they're just starting out. Well, if you don't get approved, you don't know how much you qualify for, and you may be looking at properties that are not necessarily the right properties for you. So during the initial loan consultation, we're going to determine how much you can spend. And how do we calculate that or figure that out? We're going to look at your tri-merged credit report, and we're going to look at your income. Now, a misconception is you have to be on your job for 2 years. That is a misconception. I have to show that you have 2 years of work history in the same or related field to which you're in. And what I look at with those 2 years of income is job stability. And are you getting overtime? Are you getting bonuses? So I know what income to use. And so overtime is averaged, just so everyone's aware, over a 2-year period. So when we look at overtime, it's what are you getting now plus what did you get previously? Same with any sort of bonus. I'm going to average those together. We're also looking at your assets. So in the beginning, when I said put the money in the bank, don't keep it in the house, we're using your assets to help qualify you. And the underwriting system is also going to look and say, how much money are they able to accumulate and save? Because if you're buying a, let's say, $300,000 house and you have a monthly payment of, $2,800, $2,900, but you're overdrafting your account, the system and the underwriter is not going to feel comfortable that you're going to be able to make that payment because you're obviously living above your means. So you want to show that you have money in the bank just to give everyone that peace of mind. Now, when we review the numbers, it's going to help you to determine what price of house you can qualify for and what loan program that you can qualify for. So not all condos accept FHA loans. So if your heart is set on a condo and you're at a 580 credit score, then we need to have the discussion of what we need to do to increase your credit to get you the house that you want to get. It also increases your bargaining power when you know what type of loan approval to use. So let's say you're in a multiple offer situation and you're in a situation where you need to increase your offer amount, but with whatever type of loan you picked, you're stuck at a certain price. Well, if you change loan types and you can go to a higher price, now you know that you have that bargaining power available. Same with if you were using down payment assistance or not. If we added down payment assistance, could you increase your offer amount? Most cases, likely you can. So we're also going to estimate your monthly payment and what your investment is. A lot of times with clients, when they come to me, I can qualify you for more money than you're comfortable paying. So we want to have that conversation too. What are you okay with paying? And let's formulate a plan of buying around what you're okay paying. And also, we need to have the discussion of taxes. So if you're buying in Illinois in an area where the taxes are $1,000 a month versus somewhere where they're 300 or 200, it's going to make a big difference on your monthly payment. So we're going to want to look at where is an actual good monthly payment for you in those taxes that correlate with that. And we will look at the loan products that fulfill your needs because not everybody has the same needs. So let's talk about the different types of loan approvals. So a pre-qualification is good. Pre-qualification, I'll go over exactly what that difference of all three of these is. Then you have a pre-approval, which is a better loan option. And then you have a fast track approval. With the fast track approval, that is the best underwriting option for you. So let's go over them in detail. So pre-qualification, this is a verbal approval based on what you've told me, and it's an estimate of qualification. So it's not generally a piece of paper that's given to people because it's not worth the paper it's written on. With this, I can run the numbers verbally and provide calculations. I don't verify your income. Automated underwriting's not run. I don't review any sort of assets or statements. You just tell me what your monthly payments are, what you make, and I tell you about how much you can qualify for. So you are verbally providing your income and how much you have in the bank. With this lowest form of qualification, most sellers will not accept it, and most real estate agents will not accept it. So it's good to call different, if you're calling different lenders, you can ask them, what are your down payments, or I'm sorry, what are your lender fees? What different programs do you have? And to kind of see who you like, who you want to work with. But then if you start giving them information, they say, oh, I'll give you a pre-qualification. It's really not even worth the paper it's written on because most people won't accept it. Now, a pre-approval is the next step up. So think of these three as like 3 stairs. So the bottom one is the pre-qualification, then pre-approval. Automated underwriting is run with a pre-approval. With a pre-approval, the loan officer, myself, has reviewed your income, your pay stubs, your bank statements, and we've also looked at your credit. With pre-qualification, we don't necessarily need to look at your credit. We've also asked where is the money coming from and have sourced the money for the down payment. This loan, this type of approval is what most clients go out shopping with. It's good and it verifies this is the documentation that I've seen, and I'm confident that they will be able to close on this loan based on this. Now, a fast track approval is the ultimate best approval. With a fast track approval, your loan is examined by an underwriter before you find a property. The underwriter issues a mortgage commitment subject to 2 things, the appraisal and the title. So they have physically reviewed your income, your credit, your assets, and they've issued a promise to lend. So why is a fast track approval more important? Because it closes faster. You only have final conditions, title, and appraisal. So let's say you're in a multiple offer situation. This type of approval will put you above everybody else that is making an offer, because instead of going in and saying we need 30 days to close, we say we need 2.5 weeks to close. It's a much different situation and gives your seller the peace of mind that you've been fully looked at. Now, what's the difference between me, the loan officer, and the underwriter? So me, the loan officer, I memorize all the guidelines, memorize all the rules for those types of loans. The underwriter is the second set of eyes. They are the gatekeeper for the money. Nothing is funded unless they're clearing it. What are they looking at? So an underwriter is going to be looking at capacity. What capacity is your ability to repay that loan. So they're going to review the employment history, the verifications of employments, the savings. Are your accounts going negative? What happened if they did? They're going to be asking more questions and more detailed questions than I would. They're looking at risk, and they're looking at risk for the company, for FHA, for HUD, for Fannie Mae, Freddie Mac. They're making sure that they have the ability to repay the loan that's being offered. So they're looking at capacity. Are you going to pay it back? Capital. And do you have the assets? And do you have the money for the down payment? They're also looking at character, your history of repaying stuff. Did you have a bankruptcy? If you did, it's not the end of the world. Life happens, we understand. Different loan programs allow for shorter waiting periods. And there are some loans where you can buy while you're still in bankruptcy. And then some you have to wait 2 years, some 4 years. So it's just going to depend. And have you reestablished yourself as, paying on time? Are you past whatever life event happened? And then collateral. So collateral is evaluating the property that you're buying, because at the end of the day, the bank is lending on that property. They have to make sure that property is worthy of the money that they're being lent. So they're going to issue it through an appraisal. They're going to look at the appraisal to ensure that the market value is there, plus the condition of the property. They're going to look at it and make sure that it doesn't have any sort of significant issues. Is there a sinkhole in the backyard? They're going to look for things that would say this might not be a great house. They're going to look at different property types. So you're going to have different risks involved with property. So if you're, let's say you buy in a condo association, the risk is that the association could go defunct. So they're going to make sure that the risk is in line with the reward of paying off that house. They're going to make sure that there's no liens on title. So did anyone have any work done to that property? Let's say the previous homeowner had a new roof put on the property and they didn't pay for it, and the contractor put a lien on that house. They're going to make sure that if you go and buy that house, that you are not liable for paying for the roof that that guy put on the house. So that when we're looking at title, that's one of the things that we're looking at. Location. There are some location factors that can affect the loans. So like FHA will not allow to lend on a house that's next to a gas station. So it's going to look into proximity of things that could affect the approval and also influence the value. So let's say you buy a property that backs up to 294 and you're right against the sound wall. Well, if the appraiser uses comparables from 5 miles away, they're not a true comparable. So the underwriter is going to scrutinize what comparables are used to make sure that the value is there for your property, because we don't want you overpaying on it and we don't want to overlend on it either. So with the appraisal, when the underwriter reviews it, they're looking at similar properties and what is similarly selling in the area. So do's and don'ts while shopping for a house. So you definitely want to schedule a loan consultation as early as possible and schedule the appointment. I'll send out the link to everybody. And then if you have questions, I don't care how big they are, how small they are, how many times you've asked them. Ask as many questions until you feel comfortable and understand the answer. This is a lot of terms when buying a house. Don't just agree just to make me think, okay, yeah, she has it. If you don't understand, let me know, because a lot of times I'll slip and I'll use like an acronym that I shouldn't have. So just ask when you have questions. Continue living at your current residence. Don't make any moves, because if you move today and then you give me your new address tomorrow, it could affect your credit when I pull it. So it could cause like a hassle for you, and we don't want to do that. So don't just up and move. Continue paying your mortgage or rent throughout the whole process. When you're under contract on a house, continue to pay your rent, because you don't want to go behind. If we have to extend or anything, we don't want your landlord getting mad at you. And same with if you have a mortgage and you're going to go buy a new property, but you're going to sell the property you're in, continue to make your mortgage payment. Use your credit as normal. People will tell me, oh my gosh, I can't use my credit cards because I'm getting pre-approved for a loan. That's not the case. Just don't go out and buy anything huge. If you normally charge something like, $1,000, $2,000 a month, $50 a month, you can continue to do that. Just don't go out and buy a car while you're shopping for a house. Keep working at your current employer. If you change jobs during the home buying process, we will find out. Don't think that you can hide it. We do a verification of employment 3 times during the transaction. So we make sure that you're still working at your job even the day of closing. And it's not only us that does that, every lender does it. Keep your same insurance company. So when you're shopping for a house and you have a house under contract, I'm going to have you get a quote for homeowners insurance. Let's say it's from State Farm. You get to closing and you say, oh no, I'm using Farmers. Well, we've already qualified it based on State Farm. So use your same insurance company. Make sure if you're going to change, you tell me ahead of time. And stay current on all your accounts. Don't go behind on your car payment. Don't go behind on your credit cards. Keep making your on-time payments. So during the process, expect requests for additional documentation throughout the process. If you gave me bank statements And then Rachel comes and asks for bank statements. Ask, hey, I sent those to Karen. Why are they needed again? We need all pages, including the blank pages, and we need current ones. So when you gave me the bank statements, it may have been 2 months ago, but now she's asking for a current bank statement. So we have the most current one. So just ask if you've already given the documentations to one of us. If somebody asks again, ask what was it that didn't work, or that I gave the wrong thing, or it wasn't the right document. Now let's talk about don'ts. Think of this as do not pass go, do not collect $200, don't do it. Don't go out and make large purchases while you're shopping for a house. No cars, no boats, no furniture, no carpet, nothing. Don't change bank accounts. Don't make any large cash deposits. When it comes to cash deposits, there's a very small threshold of what can be deposited into your account without me questioning it. So don't put any large deposits in. When you first get qualified, I will tell you how much cash you can put in, that they won't typically ask where it came from. So in most cases, it's less than $2,000 that you can put in the bank. I talked to somebody today, they had $5,000 at home in their house. That no go. You have to put it in the bank, and then we start searching in a couple of months. Don't transfer balances without knowing ahead of time and without telling me. Reason why: it's going to require more paperwork. And you're going to feel like, oh my gosh, I gave a ton of paperwork already. I don't want to have to give more. Transferring money will make you give more paperwork. We need 2 months of bank statements from the account that you transferred it from, plus the account it went into. We always have to follow the money. Don't close any credit card accounts. When you close credit card accounts, and I'll cover this in the credit class next month, your credit score can actually go down. So don't close credit, because it can change your credit. And why that's important is I use the same credit report for 120 days. Let's say you're out shopping for a house and I have you approved for $300,000, but you decided, okay, I'm going to clean out my credit and I'm going to close all these credit cards, and your credit score drops. And then I have to update your credit. Well, now you may not qualify for the loan program for that house anymore. So don't close any credit cards. Don't consolidate all your debt onto 1 or 2 credit cards. There are some economists that tell people to do this, move it around. You don't want to do that, because increasing the liability or increasing the balance on a credit card could overuse that card and cause your credit score to drop. So you don't want to do that. Don't apply for new credit or take out new loans or co-sign on a loan. Don't think that we won't find it. There are reports that will automatically pop up once you're under contract that will tell us if a new debt is opened and when you opened it. So we do find out. And changing or quitting your job, again, we find out, don't do that. Don't max out or overcharge on your credit cards. Some people will use their credit cards to the max so they don't touch the money in their account. Not a good idea to do that, because it's going to affect your debt ratio. Don't pay collections without talking to your loan officer. Sounds counterintuitive. If you have a collection that's already on your credit and you get a collection notice saying you owe us this, pay it. Before you pay it, let's have a discussion, because I need to be able to review your credit and see what your credit's going to do when you pay that. Because sometimes credit actually goes down when you pay a collection. It sounds backwards, but unfortunately it happens. Now, let's talk about mistake number 4, not working with a buyer's agent. With the laws that have changed, buyers are in a better situation today than they were 3 months ago, 6 months ago, or a year ago. Reason why is because now they have representation from their agent and they understand the terms of that representation. So using a buyer's agent has key benefits. Now, the key benefits are The agent is the expert, and they give you expert guidance and market knowledge. They know what's going on in the area. They can tell you what comparable homes are selling for, how much the market value is, and they walk through thousands of homes. So they're able to point out things that could be wrong with that house that you may not see. They have access to listings that are on the MLS and stuff that's coming on the market. And in Illinois, they actually have a private MLS that agents only have access to. So if you're searching on Zillow, Redfin, Trulia, you will not see all the listings. You will want an agent to give you those listings. Agents are able to negotiate. When we're in the process of buying a house, I even hire an agent for my own stuff because you get up into your emotions, right? You really want the house. You could overbid on it. You could get fixated that the roof needs to get fixed. Leave it up to the agent who's the professional to negotiate. That is what they do every day with other sellers and realtors. They can give you objective advice. They can say, you know what, this might not be the right house for you, or this is the perfect house and this is why. You want to listen to what their advice is. They handle the paperwork and explain the legalities of what the contract means, plus the contingencies of how to get out of the contract. Let's say you buy a house, you put it under contract, you do the home inspection, and you find out it has a litany of problems. They will explain to you how to get out of that contract and get your earnest money back. They have connections to professionals. So let's say you need, a maintenance person, you need a home inspector, you need a referral for a dog walker. They have professionals in the area that you're looking that they trust and they know they will do a good job for you. They save time and they save stress because nobody wants to drive around from open house to open house to open house every weekend because an agent can get you into any house. All they have to do is schedule an appointment. So they're able to be your advocate in a complex situation. Let's say you're in a multiple offer situation. They're going to be able to help you navigate that and work through that process. They will also give you future resale considerations. So when you're buying, is there going to be a problem with that house? Is it next to a train track and down the street from a fire station, or where people, just are, it's noise issue? They're going to bring up stuff that could say in the future, this could be an issue. You may not care about it, and the next person may not care, but their job is to inform you of what could be an issue in the future. Now, why you should work with a buyer's agent. They ensure that you have a knowledgeable ally that's on your side. They protect your interest and they guide you through the complexities of buying a house. Now, let's talk about the NAR settlement. Prior to September 17th, the seller paid 100% of the commission for the buyer's agent and the list agent. Now, what has to happen is you will actually have a buyer broker agreement with your agent. With the buyer agency agreement, you will, when you start working with an agent, ask them for their agreement. They're going to tell you how much their compensation is. Is it 2%, 1%, 3%, 4%, whatever that number is? If the seller is not paying that, we need to include that in your numbers for the loan because you need to bring that money to closing. Prior to last month, the MLS that had the listings listed told the buyer's agent how much commission they would be getting paid. They have to remove that now. Now the agent physically has to call the other agent and say, is your seller paying commission? So if in the case where, let's say you agreed to a 3% buyer agency commission, your agent calls the list agent and the list agent says, my seller is paying 2%, then your out-of-pocket responsibility is 1%. So let's say you're buying a $200,000 home. Out of your pocket, that's $2,000. Now, that's a lot of money, right? How do we get around that and say, now I may not have $2,000? What you can do is you can ask the seller for what's called a seller credit. The seller credit for FHA loan, remember, can be up to 6%. We're using 1% of that towards the commission and the other 5% towards your closing cost. So it's not necessarily straight out of your pocket. We can use seller credits to cover that. Now, when you have this buyer agency agreement, there are key things that you're going to look at. You're going to look at the length of the agreement and how much that agreement is. So and all of it is negotiable with your agent. There is flexibility. You are not tied down for a standard length of time. Each agent has a different time frame on their buyer agency agreement. And remember, they're working for you and with you. So have an open discussion with them and don't worry about offending them or questioning them. That's what they're there for, is to help. Does anyone have any questions at this point? Okay, so let's get on to the mistake number 5, skipping a home inspection. So I have a lot of buyers that will tell me, you know what, I don't need one. I don't want to spend the money. So a home inspection, about $450. Yes, it's a sizable investment, but it could cost you $20,000 or more if you don't have a home inspection. So a home inspector is going to look for things that you don't see, that you're not aware of. So they're going to look for structural issues. They're going to look for electrical issues, plumbing issues, health and safety. So there's a radon test that you can do. Radon is a colorless, odorless gas that comes up through the ground into the basements. None of us know, and it could have a health risk. With a home inspection and a radon inspection, you can ask the seller to put in a radon mitigation system. You don't have to buy a home that has radon in it. So if you don't do a home inspection and then you move in and you do a radon inspection on your own, and then you say, well, it had radon. Well, congratulations, you bought it that way. So you want to do those inspections ahead of time. The inspector will also give you items that are not necessarily hazards of right now you have to fix, but you need to fix down the line. If you're looking at a house that has a hot water heater that's, let's say, 15 years old, the home inspector is going to tell you, keep an eye on that hot water tank. You're going to need to replace that in the near future. You can know then to allocate money into savings for when that hot water tank needs to get replaced. So they will also go in the attic of a property. Now, when we're looking at homes, we're looking at the kitchens, the baths, the yard, and you know how cute it is. We're not necessarily climbing in the attic or the crawl space. A home inspector will. So they will look for things like mold. Mold in attics happens when the bath fan will disconnect from the vent, will disconnect from the fan, and then you have moisture going up in the attic. So there are things that can happen that you don't necessarily plan on, that the inspector will walk you through and say, hey, this is there. Now, when it comes to future repairs, let's say you're looking at a house and they tell you the attic is filled with mold and you need a new roof, there's not enough ventilation, and you need some insulation. The seller says, I'm not willing to fix that, but I am willing to drop the price by $50,000. Okay, in that case, then let's look at a renovation loan and turn that house into the perfect house for you. So the inspections are used for negotiating power also for different loans that you can have. Without an inspection, you lose your negotiating power. So you always want to do that home inspection. And if you go to do a renovation loan, you're going to want to include those items from the home inspection because you want to make sure that you have all of those things handled for the future. Now, any questions after the home inspection? Yep, moving on. Okay, so let's recap what we talked about. We know our financing options, difference between grants, down payment assistance, FHA, conventional, VA. Get pre-approved before viewing a home. It's very important because are you looking in the right price point? And are you being aware of the taxes that you can qualify for? Don't just go to the bank for your mortgages, explore your options because we have programs that they don't necessarily have. Don't feel like you can navigate it on your own. Agents are there because they are the experts in the industry. They are worth their weight in gold. They know what properties are on the market. And if you're buying in an area where there aren't homes for sale, they can, in some cases, use their network to find a home of somebody that's coming on the market in the near future. Don't skip the home inspection. It's vital that you do it so you know what you're getting into. And the biggest mistake of all, continuing to rent versus buying. So I hope everybody is found that their time is well spent and that they're that they've learned a lot throughout this process. Now, as a buyer, do you feel confident in being able to purchase a home that we've gone through a lot of the process of buying and at least getting you started? Let me know in the chat on that one.
Can I please ask one question, please?
Sure.
It might sound crazy, but if you already got a pre-approved, do I have to stick with that person?
No, you
Like,
don't.
do I have to, you know, go along everything they tell me? Like, can I change?
You can. So you definitely can change. So with the agents, you do have the buyer agent agreement of a certain time that you'll stay with them. They can let you out of it if you have a falling out. When it comes to a lender, no, you are not tied to that lender. The only time you are tied to that loan and that lender is when you're at the closing table and you sign with a pen and paper. Other than that, if you've e-consented, you've gone through the process, got pre-approved, no, you do not have to stick with that lender. You can work with other loan officers. As far as say, your question was, do you have to do what they say? It depends on what they're telling you throughout the process. If it's something where you're approved, but they're asking for more documents, they may need them.
No, I've been pre-approved, but it's just I'm in a process of shopping, but I just don't like.
Right. Okay. So yeah, if there's a personality thing where
I feel like I'm being rushed, and I don't.
Right. Right.
It's
And
not
in
right.
that case, no, you don't have to stick with them. You can shop and you do have that approval and you have the ability to get approved at a different lender too. And when it comes to getting approved, some people are concerned about having another lender look at their credit because they've already been approved and they're worried about the inquiries. So when I pull your credit, I'm going to pull a tri-merged report, which means it's all three bureaus. And when I pull that, if you want to go and shop at a different lender, you most definitely can, because the loan program itself, most lenders have the same programs with some variations. Some will have more products than others. The lender fees will be different and customer service will be different. So the scoring algorithms, they know that you're going to likely shop for a loan. So when you have another inquiry, it won't necessarily drop your credit because they know that you're out looking for a loan. And before we hang up, I forgot to mention it in the beginning. When we talk about a tri-merged credit report, if anybody has had their credit run and they have a loan officer that gives you a score that's different than what you see on Credit Karma or Equifax or what your bank is showing you, I forgot to mention the reason why is there's two sets of algorithms when it comes to credit scores. One is for long-term debt and one is for short-term debt. When it comes to Credit Karma and what your banks show you, that's for short-term debt repayment, like credit cards and cars. When I pull it, it's looking at a 10-year history back of repayment of long-term debt. So the scores that you see, they may be lower what I see than what you have, or they might be higher. It may just depend on your particular situation. So that's to explain what the difference is, because a lot of times I'll pull somebody's credit and they say, no, it's higher. It's not, because it's a different algorithm that we're using. So now, using these tips, hopefully you guys have found that you'll have a significant advantage when it comes to buying a house, knowing that you can get a fast track approval and be able to negotiate above and beyond what everybody else has, having the ability to ask somebody questions, and having that peace of mind, I think is quite valuable when it comes to buying. So if you found it interesting and valuable, I thank you for your time. I know it's a huge commitment spending, Tuesday evening with me. Thank you for coming. So to thank everybody, when you get a fast track approval for attending, I will give you a $500 lender credit at closing. So what I do is I will reduce a discount fee or our lender fee by $500 because you attended today's webinar. When I qualify you, you need to tell me you were on the webinar to get the $500. Okay. So schedule the appointment with me to ask me any questions. And with the consultations, they are a limited time. So I do these classes every 2 weeks. So I do book out usually a 7-day period. So when you schedule an appointment with me, this is what it's going to bring you to, is a calendar that you'll pick your time, and then we'll schedule a call. And if there's anything that I missed, let me know. I will invite everybody to the credit class that I'm having next week. If anybody wants to attend the class for credit, renovation financing, VA, or investing, if you've been receiving automated text from me, just text me back any of those topics, and I'll make sure that you're included on the invite for those particular programs. So with the investing program, we'll teach you how to get your first property and how to understand the BRRRR method and build up a portfolio. When it comes to VA, how to specifically work with VA loans and renovation financing. If you're in an area that has no homes that are fixed up and move-in ready, well, we'll go through the ins and outs of renovation financing. Credit, if you know anybody that's struggling with credit, not sure how to raise their credit or understand how credit is calculated and how different things affect your credit, text me credit and we'll get you signed up for that class. So I appreciate everyone's time again. If anyone wants to hang out and ask me any questions, I'm here for a couple more minutes. And I'll stop the recording now.